This morning, I want to review performance of our accumulation funds, our trends in annuity payments, take a brief outlook on the economy, and then talk about what long-term returns may look like going forward. This is a histogram that shows large cap equity returns by calendar year, and it's grouped in increments of plus or minus 10%. And the higher returns are over on the right side of the chart, and the lower returns are on the left side of the chart. And as you can see, and probably don't need to be reminded, 2008 was one of the worst years for equity returns since 1926. I'm happy to say that 2009 we staged a remarkable recovery, and the S&P, that is a large cap, was up 26.5%. And that is well above average returns. If you take a look at average returns over this period, large cap equities have returned about 9.8%, so we were above average last year. What happened was late in the first quarter of 2009, the markets turned around, and on a global basis. And they turned positive, and they didn't look back for the rest of 2009. They moved up sharply, and we were happy to see that. And the initiatives that the government had taken took hold, and we're going to see some of that in some economic indicators. This chart is a chart of housing prices. And as you can see, housing prices began to accelerate very rapidly. They went up 71% in just a matter of 4.5 years. If you put that in the context that housing usually goes up in line with economic growth, if you just annualize that 71% growth rate, that would equate to more than a 12.5% increase in home prices over that 4.5-year period annually, when normally house prices would have been expected to increase 3 to 3.5%. So that was the forming of the bubble. Then it burst in July of 2006, and house prices began to fall. They fell more than 32.5% until they began to stabilize in April of last year. So that was one positive development. This chart is a chart that shows economic growth. The economy, in the wake of the financial crisis, fell off of a cliff. Beginning with the third quarter of 2008, we experienced 4 consecutive quarters of negative growth. Finally, in the third quarter of last year, economic growth turned positive, and was positive for the last 2 quarters of 2009 and has continued into this year. However, for all of 2009, economic growth declined 2.4%. That was the worst annual growth rate in the U.S. since 1946. So it's really a severe downturn. The one area that we haven't seen real improvement is in the employment rate. And you can see that in the wake of the financial crisis and the steep recession, that unemployment rate more than doubled, and it ended 2009 at 10%. It's improved somewhat. We had an employment number that came out this morning. New jobs were about 431,000, and the unemployment rate dropped to 9.7%. But the market's disappointed because a lot of that, one, the increase in the non-farm payroll number is census workers, which will be temporary. The drop in the unemployment rate, many people feel that that is because of discouraged workers, so we'll have to take a closer look at that. Now, people dropping out of the workforce. Most economists feel that the unemployment rate is going to come down relatively slowly in this recovery. It's what they call a jobless recovery. I'm happy to report, though, that in our funds last year, all of our accumulation funds beat the respective benchmarks. We participated in the rally. This is a chart of the equity fund. It shows the growth of $1 over the last 10 years. So if you had invested $1 at the beginning of 2000, it would have grown to $1.05 by the end of 2009. The equity fund returned 26.5% last year, but you can see this trend. The last 10 years was not a good period for equities. And if you took a look at that and annualized that, equities would have only returned 1% annually over that 10-year period. If you had taken $1 and invested in the S&P 500, it actually would have decreased to 90 cents. And so you would have experienced a negative growth rate of about 1% a year. The balanced fund was up 21.1% last year. And that compares with its policy benchmark, which is 55% S&P 500 and 45% Lehman Government Credit Index. And that policy benchmark was 16.6%, so we did pretty well versus that benchmark. Now, if you'd invested $1 in the balanced fund at the beginning of 2000, it would have grown to $1.34 by the end of 2009. And that equates to about an annualized growth rate of 2.9%. If you put $1 into the policy benchmark, it would have grown to about $1.30, which is about 2.6. This shows a chart of if you had invested $1 at the beginning of 2003 in the bond fund, would have grown to $1.38. Really, this has been a great period for bonds. Last year, our bond fund returned 13.3%, and the benchmark that they're measured against is the Lehman Gov Credit, and that was only up about 4%. So the bond fund had a great year, and it's been a great time to be in bonds. I'm going to talk a little bit what bonds look like going forward. This is our stable value fund, and stable value is really for savers, not investors. When you put $1 in, you earn some income, and that's what you get. But as you can see, we began in 2005, and if you put $1 in at the beginning of 2005, it would have grown to $1.19 over this 5-year period. As Mike had mentioned, money market funds aren't returning much. Our stable value fund last year returned 3.3%, and if you look at the average money market fund from Lipper, it returned just 1/4%. So the stable value fund has been, a good place to be rather than money markets. So over this time period, on an annualized basis, it's grown about 3.5%, whereas the average money market fund has grown about 2.8%. As Mike mentioned, our target annuitization date funds, these funds began in April of 2007, so they have a relatively short history. But you can see that of the 4 funds, how a growth of $1 would have performed. I mean, in the case of the 2015 fund, you would have made some money, but 2020 through 30, you're actually down because of the short time horizon and how bad the markets have been. These funds automatically adjust to become more conservative to minimize the risk of loss as you approach your annuitization date. You can see the allocation of these funds at the bottom. They invest in the equity fund, the bond fund, and the stable value fund. And as time goes on, the equity percentage declines as you approach, because equities obviously are the most volatile part of the market.